is accounting for a small business? To put it simply, accounting for a small business is the process of recording every transaction that takes place in your company. This process of accounting includes recording, organizing, analyzing, and reporting on all these transactions that are taking place. And that information can then be used by people inside the business, owners, banks, regulators, or even the tax authorities. Accounting is a way of recording everything that's happening in your business so the data can tell a story of what's going on and how your business is doing. Without that data, you can't optimize how your business is doing nor map out where you're going or how you're going to get there. This is precisely why accounting plays a crucial role in running a successful business. And it can either save your company if things are getting tough or strengthen its performance when things are looking well. Basic accounting terms. The first step in learning any new language is the ABCs. So here are a few basic definitions to help you set the stage. Assets. In accounting, assets are resources that your business owns or controls and that can usually be converted into cash. Assets for a small business can be things like land, office equipment, machinery, or inventory, and even things like investments in other businesses or cash held in various currencies. Liabilities. Liabilities in accounting are mostly the debts that you owe to third parties. This includes things like loans, mortgages, credit cards, and amounts owed to your vendors. It also includes customer deposits. So if a customer paid you to do a service, that payment is a liability until you've actually performed the service for them or refunded them. Basically, if you've promised to pay someone and you haven't paid them yet, or you owe someone something of value, that's a liability. The third component in accounting is equity. And this is where people get a little bit confused. Assets and liabilities are pretty straightforward, but equity can be a little bit more complex. Equity in accounting is your company's remaining value after you've sold off all your assets and paid off all your liabilities. So to put it simply, the value that your company owes you or other owners is your equity. The accounting equation. So putting all those definitions together, to find out the value of your equity, you simply need to subtract all of your liabilities from all of your assets. Or to put it differently, everything you have minus everything you owe is equal to everything you own. So if you write this a little bit differently, you come to what the basic accounting equation is. Assets are equal to liabilities plus equity. The reason it's written this way will become clear a little later. This basic formula is the foundation of all of accounting, and the most important aspect is that it always balances. That means that everything a company has, meaning its assets, was purchased with money it owes to someone, liabilities, or from its own money, equity. So if all sides of the accounting equation don't balance, that means there's something wrong with your accounting. That's because we use something called double entry accounting, and it's because of that it's very difficult to put the equation out of balance. But before I explain double entry accounting, let's expand a little bit on assets, liabilities, and equity. The chart of accounts. To keep track of all the transactions that take place in your business and to make sure that the accounting equation always balances, we use the chart of accounts. So remember the assets, liabilities, and equity? All the accounts that fall into those categories, so cash, inventory, debt, investments, etc., they're all listed in the chart of accounts, and every transaction that takes place is recorded in those accounts. So, for example, if you receive a $100 loan from the bank, that transaction will be recorded in your cash account as well as your loan account. The chart of accounts is actually quite flexible, and a business can add as many or as few accounts as it wants. But you want to balance that with keeping things neat and tidy. Some accounts you'll find in every business, like cash, but some other ones, like investments, aren't always relevant. So for example, most businesses will have an inventory account. But if you run a marketing agency and you don't sell inventory, then you don't need an inventory account in your chart of accounts. There are 5 major categories found in the chart of accounts. Assets, liabilities, equity, these we've already talked about, but there are also revenues and expenses. So, just to sum up very quickly, assets were everything you have in your company, so cash, inventory, machinery. Liabilities were everything you owe as a business, accounts payable, credit cards, everything. Equity was everything that was left that you own, so common stock that was invested into the company or retained earnings that your company has earned but not paid out yet. But additionally, we have revenue, which is simply the money your company earns from selling your product or service. And finally, expenses are the amount spent by your business to provide for those goods or services, as well as pay for overall operations. And like I mentioned, these 5 main account types can be subdivided into specific categories in different accounts based on your business's needs. Creating these accounts and properly categorizing the data into them is essential for you to be able to make better business decisions. In the end, the chart of accounts is where we record every single transaction that takes place, and it's a fundamental part of creating a reliable accounting system for your business. Double entry accounting. But how exactly do we use the chart of accounts to help us keep the accounting equation in balance? For that, we use a method called double entry accounting, and with it, it's nearly impossible to keep the accounting equation out of balance. Double entry accounting is a method that tracks exactly where the value is going in and out of your business. In double entry accounting, every single transaction that takes place affects not 1, but 2 accounts in your business. but it probably is a little bit easier to understand this with a few examples. Let's say I borrow $100 from the bank. I don't just record that I have $100 cash. I also record that I have $100 loan. Both numbers balance, double entry accounting. So now say I decide to spend that $100 of cash to buy some inventory. I have to record that $100 left my bank account, but I also record that $100 of inventory entered my warehouse. Both numbers balance, double entry accounting. So far, pretty easy, but let's kick it up a notch. Now say I find someone to buy my inventory. I says to him, Mike, would you like to buy my wonderful inventory for the reasonable sum of $200? Mike agrees, and he buys my inventory. So I record the $200 of cash received and $200 of revenue. Both numbers balance, double entry accounting. But we're not done. Mike took my $100 of inventory with him, so I record a $100 inventory reduction and a $100 inventory expense. Both numbers balance, double entry accounting. While the concept of double entry accounting can get more challenging as the transactions get more complex, at its core, it's really always the same principle. Every transaction has two parts. Those parts always balance, and that's why the accounting equation and the chart of accounts always balance as well. It's almost elegant in its simplicity. To find out more about double entry accounting, check out the video in the corner or check out the link in the description box below. Now here's where I need to throw a little bit of a curveball. It's one of the most unnecessarily confusing concepts in accounting, and mostly because of the unintuitive naming. But I'll do my best to help you through it. It's the concept of debits and credits. Now I will try to give you a complete explanation of debits and credits in a second, but first let's just memorize these three rules. Rule number 1, debits mean left and credits mean right. Rule number 2, for every transaction in your business, the total debits must equal the total credits. That means that if you debit one account for $100, you have to credit another account for the same amount. That's why everything balances. Now it is possible that for some transactions more than 2 accounts are affected, but remember, it'll never be less than 2. And that's why rule number 2 is when one account is debited, another must be credited. Now rule number 3 is usually the one that causes the most confusion, but bear with me and we'll figure it out. Rule number 3 is this. It depends on the account whether a debit or a credit will increase the balance or decrease it. So, you remember our formula, the foundation of all of accounting? Assets is equal to liabilities plus equity. Rule number 1 was debits mean left and credits mean right. So as you see in the formula on your screen, you have your assets on the left. So you just need to remember that. On the left side, debits increase the balance and credits do the opposite. They decrease the balance. Let's think of cash as an example. Cash is an asset, so it lives on the left side, the debit side. So if you receive cash for providing a service, you debit cash to increase it because debits increase the left. And on the flip side, if you take cash out of your account, say to pay off a loan, your cash balance decreases. And remember our rule that the balances on the debit side are increased with debits and decreased with credits. So when your cash balance decreases when you pay off that loan, you credit it to decrease the cash balance. Now let's look at the same thing on the right side of the accounting equation. It's basically just the opposite. So if you remember, credit means right. So on the right side of the accounting equation, credits increase the balance and debits decrease the balance. It's just the opposite. So for example, let's say we take out a loan for our small business. Loans are liabilities, and liabilities live on the right side of the accounting equation. When you take out a loan, the value in the loan account increases, so we credit it to increase the balance. And when you pay off the loan, you decrease the value, so you debit it to decrease it. Except there's one more tiny wrinkle. Equity consists of revenue minus expenses. That's because equity is what your company is worth, and that is increased by revenue and decreased by expenses. So because equity is on the right side of the equation, anything that increases equity, like revenue, will be increased by a credit. And anything that decreases equity, like expenses, will be increased by debits. So that might be kind of confusing, but if we use a few examples, you'll see how it actually becomes rather intuitive when you think about it. So say for example, somebody pays me $100 for a service. I have to debit my cash by $100 to increase it, but to balance my revenue, I have to credit it by $100 as well. So now let's say for example, I take that $100 and I pay someone to perform a service for me. I'm going to decrease my cash balance by $100, which means I credit it. So I have to debit my $100 to the expense account to balance. Just remember, it always balances. So that's the key thing to keep in mind. If you're still stressed out, don't worry about it. I know it can be a little bit confusing, but over time it will become more intuitive. Now, if you feel like you haven't fully grasped the concept, you could watch our full video on debits and credits by finding the link in the corner or in the description box below. So just to sum up, when using double entry accounting, every transaction that takes place affects 2 accounts, one debit and one credit, and they always balance. And in turn, that's why your assets will always be equal to your liabilities plus your equity. And honestly, pretty much everything else in accounting is basically an extrapolation of these concepts because the accounting equation always balances. The basic accounting reports. So now that we're through all that, the next question is, what are we going to do with all this information that we're recording in our chart of accounts with all of our debits and credits? In order to actually get useful information from all of this data, we use a bunch of different financial reports to understand the health of a company, but there are three main financial statements that we use. In this video, we're not going to go into the three financial statements in too much detail, but each one is quite important. So if you want to learn more, check out the links in the description box below. But briefly, the three financial statements are as follows. The income statement, also known as a statement of profit and loss. The income statement is meant to tell a story about where your company is earning its revenues, where it's spending its expenses, and where its profits are coming from. It does this by detailing all of your revenues and expenses over a certain period of time. The balance sheet, on the other hand, is a snapshot of your business at a specific point in time. It shows the balance of your assets, your liabilities, and your equity as at a specific date. So for example, how much cash did you have at December 31st? The cash flow statement. The cash flow statement details how cash went in and out of your business over a specific period of time. This is actually helpful because the income statement doesn't only look at cash transactions. Say for example, you spent $100 of cash on buying inventory. This wouldn't show up on the income statement because it's not an expense, but the cash flow statement will show that $100 left your business. The reason for the difference is because of cash versus accrual accounting. Now, we won't get into that here, but if you want to learn more about it, you can find the video in the corner or a link in the description box below. Please don't get discouraged. I know this stuff isn't the easiest in the beginning. And even though I've been a CPA for like 10 years now, when I got my first dose of intro to accounting in university, I was completely lost and thought I was going to be screwed. And funnily enough, I had a friend who was studying to be a dietitian who took a business class where they also touched upon intro to accounting. And it was that friend who spent like 15 minutes explaining everything to me, and then it all clicked. And now I'm a CPA. The way it was explained in university was just too confusing, so if you stick with it, you can get it too. So thanks for watching, and if you'd like to learn more about accounting or running a business, please like, share, and subscribe, and click all the other buttons you can find. And remember, good accounting always balances. For now, take care.